Hey, welcome back. I'm Josh High with Swift Home Mortgage, and today we're talking about something a lot of buyers are dealing with right now: getting help to buy a house. Gift funds from a family member, seller credits, lender credits, down payment assistance programs, co-borrowers. This is all very common, and more common now, I think, really than it's ever been. Home prices are up, closing costs are up, insurance, taxes. And for a lot of buyers, especially first-time buyers, the monthly payment isn't the biggest hurdle associated with buying a house. The upfront cash is the biggest and the main obstacle. So people get help, and that's fine. We love to see it. But where buyers get into trouble is accepting money, moving money around without a plan, depositing money without telling their lender first. That creates problems that one quick phone call could have prevented. There's a right way and a whole bunch of wrong ways to move money around when you're buying a house. So let's walk through how all of this actually works. Gift funds. Gift funds from a family member are one of the most common ways buyers cover their down payments or their closing costs. But a gift is not just someone sending you money. For mortgage purposes, it has to be documented. The lender needs to know who gave you the money and what their relationship is to you. How much was it? What date was it sent? Where did it come from? Is it a gift with no expectation of repayment, or is it really just a loan to help you get through this purchase? That last part is where people get caught. If you're expected to pay the money back, that's not a gift. That's a loan, and a loan gets counted towards your debt-to-income ratio, and that could send you out of qualification. You have to be real careful with that. Gift rules vary by loan type. The rules around gift funds are not the same across every single type of loan: FHA, conventional, VA, etc. FHA is generally pretty flexible with gift funds from family, and it's also commonly used with non-occupying co-borrowers when the family member is helping you qualify. Conventional loans allow gift funds too, but the rules can shift depending on occupancy, property type, down payment amount, and other factors. VA loans can allow gift funds, but most VA buyers are already at a 0% down payment. The gift in that case is usually more relevant towards closing costs, reserves, or maybe paying off debt to help qualification. USDA has its own rules as well, but with USDA, the bigger question on that program is whether you actually qualify with income limits. Does the house qualify? Does the property qualify? Does everything fit that program? USDA is a very, very tight program to fit into. So don't assume one rule or one thing that you pick up out of this applies to every situation and loan type. We need to look at your specific set of circumstances specific to you and the house that you're buying. Now, the paper trail. If money moves during the loan process, the lender may need to document that full chain of movement. And that can mean the gift letter, the donor's bank statement, proof the money left their bank account, and proof that it landed in yours. And we're not doing all that for fun, I promise. We're governed by a lot of different laws, especially through the federal government, the Patriot Act, anti-money laundering. Those laws are looking out for money transferring activities because that's how they catch money laundering. That's how they catch terrorism, drug dealing, all that kind of stuff. So we're not in the business of any of that. You're probably not either, but that's why we have to look at all this stuff. That's why we have to document and paper trail all this stuff. It's not because we want to. It's not because we made it up and we want to know more than we need to know. That's not how it is at all. We're here to verify that the money is legitimate and it's allowed under the program that you're qualified for, and it's not an undisclosed loan. Those are the three main things that we're looking for when it comes to gifts. The cleanest path is to talk to your loan officer before any money moves around. Sometimes the gift goes straight to closing. At the title company, it goes into escrow. That way, when the sender, that donor of the gift, they can put it into the escrow account, and if the deal falls apart or you cancel it for whatever reason, that money can go straight back to the sender, and there's no fees or interest or anything like that associated. Sometimes the money can go to your account first, if that makes the most sense. Your lender can tell you which is the cleaner way to do it and the steps to take to make that happen. One thing worth knowing is if that money has already been sitting in your account for more than 60 days, then we're not even dealing with a gift fund anymore at that point. At that time, those funds are considered seasoned, right? So you've 60 days, you've owned it for 60 days. That's as far back as we're going to look. So we don't have to call it a gift. We don't have to trace the gift letter donor's bank statement, anything like that. Those are your funds, and that's your money to use as you see fit. But if the money suddenly shows up in the account in the middle of a loan process, now we have to explain that. So if your family's going to help, bring it up early. Don't wait until the week before closing. Don't deposit the cash or shuffle money around through a bunch of different accounts. Don't start accepting Venmo transfers or PayPal gift funds or PayPal transfers. Talk to your lender before anything happens. We can almost always find a way to help you with a solution. You'll notice that I keep saying that it's your specific situation and your specific set of circumstances. Every buyer is different, every house, every credit profile, every bank account. It's all specific down to your certain set of circumstances. And that's why we want to take a look at it case by case. We can't blanket everything. These are just some general, well-documented tips that I'm sharing with you today. Another form of assistance is seller credits. A seller credit means that the seller agrees to contribute money towards your allowable costs at closing. That can cover closing costs, prepaids, escrows, discount points, certain fees. Sometimes consumer debt can be paid off, but seller credits can't function as cashback. They can only apply to allowable costs. So if you negotiate a $10,000 seller credit and you only have $7,000 in costs to cover, that extra $3,000 might not help you unless we can find a place in the loan or the transaction to absorb it. We can almost always find a place for that extra money to be applied. A lot of times that's through discount points and helping you buy your rate down, or maybe applying it towards escrows or prepaying an insurance policy or something along those lines. Seller credits also have limits that vary by loan type, occupancy, down payment. Don't write a number into your contract or your offer assuming that it's going to work and that you need it to qualify if that might not qualify under the loan program that you're going to be in. Run that offer by your loan officer before the offer goes in. Make sure that you're good on that. And also note, seller credits can't cover a down payment. So a seller cannot contribute to your down payment. If you have an FHA loan, you're putting 3.5% down. You have to bring that 3.5% down of your own funds. Now your own funds can be gift funds. It just can't come from the seller. That would need to be a gift fund through another source. They can only be applied, the seller credits can only be applied to closing costs and prepaids and those other items that I talked about. Lender credits is another way to get some funds covered. A lender credit is different from a seller credit. This is where the lender covers some of your closing costs, usually in exchange for a slightly higher rate. Sometimes, not always. That trade-off isn't automatically good or bad. If you're short on cash and you need help getting to closing, it can make sense. But less cash to close usually means a higher monthly payment. So the question for you is, does that trade-off work for your specific situation, or is the credit available? Like, you might not want the credit if you can get a lower payment over 30 years. You have to weigh that out and see what makes sense for you. Now, down payment assistance, probably the most popular item. Down payment assistance can help, but I want to be careful with the phrase free money. Some programs are a true grant, some are a forgivable second mortgage, and some are a loan that you eventually pay back. Some come with income limits, purchase price limits, location restrictions. Most carry higher rates and fees. Some create a lien on the property. Some have repayment rules to where if you sell your home or refinance the loan too soon, you have to pay that back, and that could eat a chunk of your equity you weren't expecting. None of that makes the assistance bad or good. It can absolutely be the right call for the right situation, but it's not always the simplest option. Sometimes a seller credit or a family gift can get you to the same place with fewer strings attached. It's always going to be cheaper to use your own money or your own gift funds over down payment assistance because you're going to have better programs, better rates. You're not going to have to deal with repayment later on down the line. There's all kinds of reasons why using your own money is going to be cheaper than assistance. But the down payment assistance might be the only option. And when that's the case, it is what it is. That's a great program when it works. Your lender can help you compare and choose what all makes sense in this situation. Now let's talk about co-signers. A co-signer, in mortgage terms, a non-occupying co-borrower, is not just a character reference or somebody vouching for you on a loan. We're going to treat them like a full-blown borrower, just like you. We're looking at their credit income, assets, debts, and all that goes into the file, and we're treating them like a regular borrower. The only difference is that they're not going to live in the home because they're non-occupying co-borrower. And what really surprises people is if the loan is always going to use the lower credit score of everybody involved. So we're using the middle of the three bureaus for your individual credit score, and then we're using the lower of the two when it comes to multiple borrowers. If there's three borrowers, we're using the lowest of all three. So if we're using that lowest credit score on the file, adding someone with a lower score may hurt the loan and kick you out of a loan program, even if their income helps. People come in and say, hey, my dad makes great money. Let's just add him to the loan to help us qualify. But if dad has a lower credit score or a high debt ratio, adding him might not help. It might make the file harder to approve. A non-occupying co-borrower can be a great tool when it works, but you have to run the numbers first. It's always possible, but we're going to treat them like a normal borrower. And when it works, it works. When it doesn't, we know pretty quickly. So the practical takeaways here is before you accept any money or move money around or deposit it or make any changes to bank accounts or receive any gifts, talk to your loan officer. Before your parents transfer funds, call us. Before somebody pays off a debt for you, or if somebody wants to give you cash, or if you negotiate a seller credit, call before you get into that. If you want to know more about down payment assistance programs, let's get a game plan together. You shouldn't be going blind on this kind of stuff. Before you add any co-borrowers, before you have that whole plan kick off, let's run it all and see how it works. We can do a lot of work without even getting to a credit report and really understand kind of what you're up against. Any one of these things that we've talked about here can all be a great answer to your situation, but they all have to be set up correctly. A good plan protects your approval. A sloppy money trail can cost you the deal late in the process after you've already paid for appraisals and inspections and who knows what else you might have paid for during this whole period. Your escrow money that you put down with the offer could be at risk, and we're talking about thousands of dollars now. So you want to make sure that you're approaching this correctly and not going in without a proper plan. Getting help to buy a house is not something to be embarrassed about by any means. It's how a lot of people are getting it done these days. And that's just common. That's just the market that we're in. The money just has to be documented correctly. The loan program has to allow it, and your lender needs to know before any of that happens. Because in our mortgage world, it's never just about, do you have the money? What we're really saying is, can we use the money that you think you have? I'm Josh with Swift Home Mortgage. If you have any questions about any of this, feel free to reach out. I help people every day coming up with game plans, getting them great deals on mortgages, offering second opinions, and putting a plan into action. So give me a call, 813-606-4255. Visit me online, getwithjosh.com, and I hope to talk to you soon. Take care.